Hello friends, hope you and your family are well. A few of my viewers suggested that I create a video in light of the current Russia-Ukraine war and how do I look at equity investing. So welcome to this video. Friends, before I proceed, I would like to give this disclaimer that the purpose of this video is not really to recommend any strategy, but I'm just sharing my own thoughts in terms of how I'm approaching it. And I would request you to do your own due diligence in terms of whether you agree with my approach and take an independent view. So again, not only a disclaimer, but at a later stage, I've also given my disclosure of where I stand. So my objective is really to give you a perspective, but I leave the final judgment to you. Well, actually, world was just getting out of COVID-19 pandemic, and we thought that's all over, so we can go back to life as usual. And we now suddenly have another challenge on hand, which was a little unexpected. We had thought that Cold War was long over after the breakup of Soviet Union, but it was not only simmering, it suddenly became a hot war, which was completely unexpected. Initially, we thought that countries were just posturing, but actually within no time, Russia invaded Ukraine. Of course, US had given some of those signals that Russia had amassed a lot of their military on the Ukraine border, but there was also news that Russia was retreating back, and then suddenly there was this attack. So it was quite unexpected for the world as well as, of course, for the investors. I'm sure Russia has very legitimate reasons. There are also suggestions that Russia has been really pushed to the wall, and that's why they had to give this kind of a reaction. The fact is that relationship between Western world and Russia has, in my view, changed forever. The distrust would only clearly grow. There's no question about that. Now, would it give birth to new challenges in the future? To my mind, it now looks almost certain. So these kinds of flare-ups, particularly which result into humanitarian crisis, particularly in the Europe or European world, which were thought to be far behind them after the Second World War, suddenly they're coming back to their doorstep is something that must have rattled a lot of people. I'm sure a lot of assumptions may have gone wrong at their end. So to me, it looks quite certain that it is going to give birth to new challenges in the future. At the same time, while China is observing from the sidelines, or who knows, they may be even working behind the scenes, it is quite possible that they may also indulge in some adventurism in Asia Pacific. That's something which is quite possible. So the question arises that as equity investors in India, what are the risks for India? Because finally, investing is about dealing with probabilities, investing uh, is about managing risk. And as I often say, the essence of success in equity investing is not about chasing returns, but rather managing risks. And therefore, of course, I have talked about defensive ways of investing. I have the whole equity investing series, which really talks about how retail investors have to focus in a defensive way. I have advocated investing through holding and investment companies as a way of cushioning our investments. And as far as I'm concerned, that has really helped me, to cushion the effect as well as, to help us managing our own mind. Because otherwise, at this time, when you suddenly find that the market has corrected by 16% from the top, and some of the stocks may have been really battered very, very badly with a fall of 50–60%, it really starts giving you nightmares. So this is the time why we need to again, look at our own portfolio. And as I have created or I have talked about in my own videos, it is really continually improving our risk profile is very, very important. So I will provide links to some of those videos in the description box. So those of you who have not explored them may like to explore. But that's essentially been my theme of investing, that I would, get into defensive investing all the time, and that prepares us for facing these eventualities. Now, we have also gone through a much more challenging situation, which was COVID, and at that time the fall was even more severe. As far as my own portfolio is concerned, between March 2020 and exactly 2 years later, the portfolio is still healthy 3 times as compared to the March 2020 portfolio. So, to that extent, of course, applying these principles has really helped me. At that time, of course, in March 2020, when when my own portfolio had fallen by 50-55%, at that time also I had created a video on April 4, 2020, in terms of how do I look at the pandemic, and I had also talked about certain opportunities. Some of those are obviously overlapping with the video that I have created, so the themes remain the same even now. So what we need to be aware is, what are the risks for us as the country? The risks include flare up in oil, which has already happened. Some more may happen, and that causing increase in inflation. There could be some disruption in some supply chains. Like we all know that Ukraine is a powerhouse in terms of food grains. Russia is a powerhouse in respect of oil. It ranks in the number 2 oil suppliers, oil exporters in the world. Natural gas exports to Europe. Now, there are going to be even more perhaps sanctions or announcements forbidding even oil imports from Russia. So that may even flare up oil further, and that obviously would cause problems for us in terms of current account deficit, fall in the rupee. Some fall has already taken place, but even more can happen. Widening fiscal deficit, some of those trains, and who knows, some China adventurism like in the past. So some of that can again cause a lot more anxiety to the market. That's quite possible. Now the real issue is, how long would this scenario continue? Because finally what we are talking about is really the probability of this remaining as a scenario forever, or the possibility of it reversing. So if this remains as a scenario forever, for example, if oil remains at heightened levels forever, it's really going to be very damaging for Indian economy. There is no doubt about this. But sometimes it so happens that these flare-ups or these flames can also be doused quite quickly, and then the scenario can reverse also. So the real question is, how long would this scenario continue? Let's try and explore some answers to this question. Now, in my view, it may continue till the cost of the war and its fallout becomes unbearable for the parties involved. So today, for example, there was a news that almost 4,000 Russian soldiers have died. So perhaps some miscalculations may have also happened on the Russian part, and now that starts creating some tensions within the country. Similarly, the humanitarian crisis in Ukraine, again, I'm not getting into whether Ukraine has been on the right side or Russia is on the right side, but the point I'm only making is that when the cost of the war and its fallout becomes unbearable, and while Russia, for example, has postured from nuclear weapons and those kind of things perspective, but I'm sure Mr. Putin is also a very wise man, and he knows what is the threshold that he can't afford to cross, because then once you cross that threshold, then it can become a no holds bar battle. And then whatever restraint that NATO and some of the Western countries may have observed, some of that may undergo rapid change. As it is, this scenario, which was quite unexpected for the Western world, because they thought that Russia will not cross beyond a certain level of war, but indeed it has already crossed. So now, how long can they sustain this war? Because invading another country is never easy, because you could have resistance which can obviously come up, and obviously to push into inner territories is never going to be easy. Plus, Russia may also have its own vulnerabilities, particularly in the context of intercontinental ballistic missiles. So, it's never going to be easy to continue to be in a warlike situation for too long, because finally there are also internal stakeholders who are going to observe, and that also is going to create tensions internally. Plus, finally, the economic cost of war is also quite high. Plus, also Russia has to sustain its own economy if it's not able to export things. They have, of course, hinted that they will also find buyers who are allied with them, and that's how they will defy the Western sanctions on them. But at the same time, a stage may come when the cost of the war becomes unbearable for the parties, and they may come back to the negotiation table. If they come back to the negotiation table faster, this scenario can get reversed much faster. Though, of course, as I mentioned earlier, in my view, this is only going to create more distrust in the future, and we won't be surprised if it keeps on creating these kinds of flares up or flare-ups down the line also. So, but that's something for the distant future. For the immediate future, if the parties return to the negotiation table, a lot of things may get normalized. Uh, some of the damages which have caused of course, the Ukrainian economy may take time to heal. The damage in terms of people's psyche may take time to heal. But of course, in terms of the asset prices, a lot of normalization can happen. Though, as I mentioned, the distress may continue for long and it can create challenges in the future. But at least the markets can gain calm till, of course, new problems arise sometime in the distant future. So, since investing is about probabilities, I think there is a certain weightage that we also need to give to this probability, that beyond a point, no country would afford to stretch it, because finally, though it may win a battle in the short term, but in the long term, it may lose a war. So, no country may afford to do that, and therefore, there is a high probability that countries may come back to the negotiation table. The question is how long it may take. It may, of course, take a couple of months before they, finally give up and say, fine, I think it's time to negotiate and, move on. So at this stage, I would like to give my own disclosure that except a couple of lakh rupees, which I needed for my own personal reasons, considering that, I'm not an employed person and I have, of course, quite uncertain in terms of my ongoing income. Except those few lakhs which I have taken out of the market, I have not taken out money from the markets in a serious way. So even now, over 95% of my savings are in the equity markets in spite of this correction. So it will be quite interesting to see where is the market now in the context of past events. So world has faced problems in the past also. For example, in 2014, world had seen oil which was at the levels which we are seeing right now, for example, before it started correcting. So it is always good to take a clue from the past, and those of you who have not seen my video of August 2021, where I have shared my own tool of assessing market levels, I am again providing a link to that in the description box. So the data that you're going to see, you can yourself put the date as of which I have captured those numbers, and you can just cross check for yourself. So it is always good to see where the market is right now. Having seen where the market is right now, which I'm of course going to show you on the next slide, there is no guarantee that market may not fall beyond this. So market can always fall beyond this. But if it falls beyond this, like what it did during COVID situation, like it fell to a nifty level of 7,500. And then we also saw that it bounced back very quickly, because something which is unnatural cannot persist for too long. If you hold a float below water with a lot of force. As soon as that force is removed, the float is going to come up. So this works in the markets as well. So let's quickly see where we are right now. So friends, this data shows that on 8th of March 2022, Nifty was at 16,013 level. And where does it compare in the context of the events in the past? Now the dates that you see in the first column and the Nifty level on that day provides us as a reference point to see where the current market is based on the compounding principle, which is 13 to 16% is the range that I have used. Now I'm not getting into details of how this tool works, but those of you who are interested, I'm going to provide a link in the description box. So do have a look at this video, download that Excel file and check for yourself what I'm trying to convey here. But what you clearly see here is that the current level of Nifty, which is 16,013 on the date of 8th of March when I have created this video, is actually quite favorably positioned in relation to the past events. So what we find is there are a few dates like 15th of October 2008 when the Lehman Brothers crisis was unfolding and Nifty was at 2,524 level. If you were to compound at on a conservative 13 to 14%, you do find that there is a certain downside to the market possible. Similarly, when you look at the say demonetization, which is the last line in this table, when Nifty was at 7,900 level on 15th of December 2016, you find that there is a bit of a downside. Similar downside you find with reference to 15th of February 2016, when the market was relatively at a weaker level. So those are indicated in red here, but the others are all in green, which means that the market is quite favorably positioned today in terms of where it stands today in relation to the past events as well as the economic growth which has happened in the interim between those dates and now. But do explore my YouTube video related to this subject, and then you can download that Excel file and check for yourself by inputting Nifty level as well as the date. Then you can easily see where the market is. But clearly the market is positioned at a very attractive level. But that does not mean that the market may not fall further, because like what we saw in the context of the COVID pandemic, the market had fallen far more deeper than what its value suggested. So these price movements can be as a result of panic or fear. So it is possible that the market may correct even more than what it is today. But I'm just trying to tell you from a level perspective, it has already entered quite an attractive zone. So how am I approaching the market? That's the question, right? As I've already told you that I have not taken out serious money from the market. So at this point of time also, more than 95% of my savings are in equity markets. When the markets were at peak, they were even a little more than 97%. But even now I am 95% exposed. But as I've already shared with you, my approach is very defensive, which includes, for example, investing through holding and investment companies, investing through low debt companies. So therefore, the risk to their balance sheet and financial position can never be permanent. They can, of course, get impacted from a profitability perspective in the short term in case of such disruptions, but they would never be impacted in the long term because of the debt problem which may be there on their balance sheet. So my investments are very are all in companies which are very low in debt, or in fact practically zero debt. So that frees my mind. Plus, of course, I have spoken about my investing through investment and holding companies. So this is something, of course, I would request you to explore. Again, I'm providing links in the description box to this video, so you can definitely explore them. In my view, this is a market which, like what I had said during the COVID pandemic onset. So in the video of April 4, 2020, I had used exactly the same words, and I'm repeating them. This is a buy price, not quantity market. What does that mean? That if you find you have some surplus cash, you find some stocks to be very, very attractive, buy some small quantity of that, take advantage of that price, but don't open your purse in a way that you aggressively buy. So don't buy quantity right now. You should have your cash reserves to be able to you know take care of your own needs, as well as the future opportunities in case the market corrects. So in my case, of course, because I'm already exposed 95% plus to equity markets, I don't have any fresh cash to invest. However, through the switch strategy, about which again I have created videos, and including some caselets or case studies of how I had used some of these switch strategies with actual data. Of course, as I always do, I don't talk about specific stocks because I'm not registered with SEBI as a research analyst or a portfolio manager, and therefore I always follow the regulations, and I don't want to create hyper expectations or wrong expectations in the minds of my viewers. I leave it to their diligence, but I have provided a lot of tools in this regard, and I had created a video in July 2020 in terms of how I had created strategies for increasing my value repository. So you can explore that. I'll again provide a link. Same principle works today. So I'll of course talk about that a little more as we go along. So as I just mentioned, I continue to work on my switch strategies, taking advantage of undue fall in certain stocks. Uh, because always remember, valuation is relative. You can use valuation tools which are based on future cash flows, etc. But finally, it is always relative. If there is a stock which has fallen far more, than what it deserves, without putting extra cash, you can always liquidate the cash from another stock, and you can move money there, right? And you can still increase your value. As I have mentioned in one of the uh, videos, and again I'll provide a description box, in the description box, a link to that. So quite often people are just focused on price versus cost. What is the prevailing price versus what is the cost of their acquisition? But in my view, we should also have somewhere a data in terms of what is, in our view, the perceived value of a particular stock, and the difference of that value with the price. So not just price versus cost, but value versus price. And if we are able to improve the repository of our value, which is not yet reflected in the price, but it may get discovered by the market a little down the line, then we should be building that value repository. So this opportunity is provided by the switch strategies, right? So right now I'm selling one stock, liquidating money from there. It may also mean paying some tax on it, which I'm paying even in a situation where the market has corrected, but I'm buying another stock where I have a deeper value, right? So effectively what I'm doing is I am moving money into a stock which provides me deeper value, and that's one very important way of managing our risks. So it's not just to what extent are our prices more than the cost, which obviously in my case they are. But in my view, what is very attractive is how high the value is as compared to the price. So that cushion is an additional cushion that we have, and therefore, that's something that we should all be focused, particularly as retail investors, where we don't have the liberties of exposing our hard-earned money to undue risks, right? So this is something which is very, very important. At the same time, I also trust the ability of our government to negotiate this situation very well, right? So we have already seen how Indian government has been able to bring back our students who were stranded in Ukraine, right? Through other neighboring countries such as Hungary, Poland, and so on, Romania, and so on. There is another opportunity that we have as a country. So if the oil prices flare up a lot, uh, finally, if Russia is not able to sell their oil to the Western world, countries which are like India, who are friendly with Russia, who have personal relationship with them, and a deep long relationship, we would be able to procure oil, right? So in case of such flares up, I'm very sure that our government would also, kind of work behind the scenes to get Russian oil at lower prices. So right now what has happened is that a lot of weak hands in the market who tend to think linearly in respect of value. So what do I mean by weak hands who tend to think linearly? I would give you an anecdotal example of a friend of mine who actually himself is a CA and who manages, others' funds. So during the first phase of COVID pandemic, he had called me up once, and he was saying that, if company is not able to produce anything, how can value be attributed? I'm sorry, how can value be attributed to those companies? Now, this is where, there is this thinking which is linear, which means that whatever is the problem on hand will remain forever a problem, right? Which actually doesn't happen that way. So I told him that, well, these companies may even incur massive losses in this quarter, but does it mean that their value is permanently eroded? Not at all. In fact, such problems prompt companies to actually improve their risk management, improve their efficiencies, right? So even during this kind of a problem zone, the weak hands, people who have not really studied a particular stock and have jumped into buying stocks because X analyst, Y analyst had recommended that in the papers or on YouTube video. Remember, these analysts never take responsibility of your exit. They will only talk about, some, what they call as fundamental analysis, or, how, what is their perceived value, etc. But will they be able to support you on an ongoing basis, in respect of the videos that they have created in the past? I don't think so. That's impossible, right? So in a situation like this, what happens is the weak hands start thinking that this situation, which has created definitely some damage, will remain that way forever. So they start thinking that a short-term problem is a permanent problem, right? So we have seen some great companies who have inputs in terms of oil or oil derivatives for their finished products have been battered by the market, right? The damage is very, very severe, more than 20-25% value erosion of a company. Indicates that people think that the company's management does not have the wherewithal to deal with these problems. The market tends to think that, they would have never used any hedging techniques to hedge their risk in terms of the oil and oil derivatives. They would have also used their own hedging strategies, right? So the market may at the end be surprised that, the profits were not as bad as market had expected in terms of the fall in the price, right? So these can be good opportunities if you have studied the company well, right? So therefore, weak hands tend to panic and they tend to force the market down. But strong hands are the ones who would actually make an entry. So it's very important that we have a portfolio which is defensive, in the sense that we have convictions about those companies. And if we have convictions, then we will not land up in selling stocks, just because some weak hands have created a selling pressure, right? We would continue to hold them because great companies come out of these kinds of challenges very well, and in fact they are able to take the advantage, because just like there are weak hands among the investors, there are companies which are also weak, and particularly those companies which have raised a lot of debt, then they may suffer a lot. And therefore, as a retail investor, I always like to invest in low debt companies, because of the operating and financial leverage challenges, about which again I have created videos elsewhere that you may like to explore. At the same time, we must also remember that oil producing countries can't also afford too high oil prices in the long term. In the short term, they will enjoy. A lot of wealth transfer will happen from countries like India to oil producing countries, because suddenly the Indian imports bill is going to rise, right? And the oil marketing companies cannot bear the whole burden. So a stage will come when the prices will get reflected at the petrol pumps, because finally the government also has only a certain cushion. Thankfully, our tax collection is quite buoyant, and as some analysts have predicted, as compared to what the government has budgeted, the both direct and indirect tax collection may actually surprise on the positive side. And that does provide some cushion for the government to reduce taxes, central government particularly, to reduce taxes on petrol and diesel, and cushion that impact to a certain extent. And I'm sure even oil marketing companies would have also used hedging technique, to reduce the problem of a short-term flare-up in oil. Now, the short-term flare-up may continue for a couple of months. That's quite possible, right? But the oil-producing countries also cannot afford too high an oil price, because in the long term, the sustainable energy resources become more attractive, and the switch to those resources can also become quicker, and that can create a challenge for those oil producing countries. So I'm sure some semblance of realpolitik will finally prevail, and after a couple of months, it's hoped that we should be able to come back to some normality, right? Of course, those next couple of months can be challenging. So that's where our mind management becomes also very critical. Thus, the view that I have taken is that I'm not going to sell my stocks in panic, but at the same time, as I always do, I continue to improve my risk profile. What I mean is that wherever the price and value gap is more attractive, I'm going to move money there. So wherever I have a higher cushion in terms of value versus price, my money would go there. And because of my already high exposure to equity markets, I'm going to take money out where value versus price is not as attractive. So I'll take money out from there, and I'm doing that already. I'm paying taxes on it, in the sense that I'll have to pay that on my advance tax date, which is very close anyway, March 15th. Uh, but at the same time, the search for deeper value makes sense. And in fact, as a result, I'm also generating some cash. What I mean by cash is some money is getting set aside as a result of, this switch strategy. So that money, of course, I need more for my personal purposes, rather than me taking out serious money from the market, as I've already disclosed. So this is the way I'm looking at the market, and I would encourage you to take a fresh view and take your own decision. Thank you. For more such videos, do explore our channel.